What's up, everybody? Michael Silva here. You're watching the Stock Market Brief Show. We're doing a monthly recap today, looking at some monthly charts and some sector performance as well. Got to be honest, the bears are still there, and we can't be ignoring them. And there's some developments taking place that I want to kind of bring up and bring to your attention, just so if you are kind of jumping into this hype and euphoria as the market's seen a pretty nice bounce. We don't know whether it's going to be sustained or not. We need to look at a couple other developments that are taking place. So that's what we're going to do in today's video. Before we get into it, I wanted to let everyone know that I did update my Patreon. It is the same price, $9 per month. And I also was able to add in if you buy annually, 16%, it ends up only being $90 for the entire year. This is where you can get my swing trade ideas and setups. And then also, I just recently added this in there as well. So that's access to my weekly watch list in both Excel and PDF format. And what's cool about Excel is you can just copy it all, and if you use Thinkorswim, you can actually paste it or import it into there, so you can kind of go through all the charts. So pretty cool stuff. You also get access to the Discord channel and just some general support as well. So if you're not part of that, we would love you to come in and be part of the community. Let's go ahead and hop into today's episode. All right, everybody, welcome back. So month to date, let's see how these sectors perform. Our top leading sector was energy. No surprise there. It was up about 8%. Everything else was relatively flat to down. The laggard was XLRE and XLC, which is communication services and real estate. But you can see there too as well, technology was one of those laggards as well, which kind of helped pull the Qs down and kind of hold the SPY down as well. When technology and when financials are down, the SPY does, it's a lot harder for the SPY to perform. If we take a look at year-to-date performance, everything is in the red other than energy, right? So energy has been just explosive. It's up 27% year-to-date. Financials was in the green. It was up roughly around 5% in a prior month at its high peak around there. And as you can see now, it's down 1.36% year-to-date. So, the reason really why the SPY is being held up right now is because of financials. Now, if technology was down with financials, we would obviously see that SPY down tremendously more. If we take a look at the 11 sectors, just today's performance overall, energy was the leader, up 2.4%, right? We have all these geopolitical risks taking place. It's a lot of volatility in the system, which we'll talk about those risk ranges, but energy did lead the way. Utilities was up there in the top 4, in the green too as well, a more defensive sector. And then we had financials towards the bottom, which was definitely a laggard for the SPY. Technology was middle of the pack. If we take a look at what the indices did overall, not much movement. It was a lot of up and down. We started, on a big gap down. They recovered some, then we started selling off, and then we kind of came back. So a lot of volatility today overall. Let's hop into some monthly charts because the bears kind of do have the advantage right now. So we're just coming to month's end. We're coming into March. The price action on the monthly chart for the SPY closed below that 5-period EMA. So really, what we need to see is the bulls to recapture this and have a monthly close back above it. It did form a nice hammer candle, right? So if we start getting above the high and close above the high, that could perpetuate us up further. And the high of that candle was 458.12. So that'd be a number that you might want to pay attention to going into next month. Also to note, the PMO, it's still in bullish context, but you can see it's curling over. And if it has a bearish crossover, that could indicate some more further downside as well. It would indicate that if you're going long, you might have some wind at your face. IWM looks like it's about to have a bearish crossover right here on the month. Actually, yeah, it's about to. It really does. 1410, 1410, those are both the readings on the line, so they're just hand in hand next to each other. It did form a nice hammer candle, but as you can see, we're still below the monthly 5 EMA, so you want to have that recaptured. And as you can see too, it's starting to decline, which means that the trend is going into a decline phase, right? So if it goes right here, could be accumulation. Right here is a markup, distribution, and then it could be potentially a decline right here. So we need more data, obviously, but it's something to be very mindful for. And you can also see here the 5 EMA on the SPY. It's declining slightly, but it's rather neutral at this particular point in time. If we take a look at the Qs, you can see the 5 EMA, we're below that, we're well below it, and it is starting to decline right here. We did have a bearish crossover, which could indicate that anybody that's long tech is going to have wind at their face moving forward until this can resolve itself. So be very mindful of that. We'll be getting into some indicators here too that haven't became fully bearish at this particular point in time, but it is something to note because it could very well flip here soon. Let's hop into a chart of gold on the monthly time frame. Gold actually finished above that 1835 level, which is a very positive sign, because as you can see in previous months, right, every candle here, right, closed below 1835, and then for the first month, you know, in 1, 2, 3, 4, 5, 6, 7 months here, technically 8 months, right, we had a close above that level. So it does seem like we're getting some power. We want to hold 1835, and we would like to see a close above 1910, because we haven't had a close there above 1910 dating back all the way, you know, to 2020 mid-year. So that would be a very bullish development. And you can see here we have a potential bullish crossover taking place in the near future. Now remember, these are monthly candles, so it can take a while to develop, but as it looks right now, it looks positive. So if you're not involved in gold, this is the type of sector that you'd want to keep an eye on, that you can potentially look for good positive dips to buy into. If we take a look at this chart on the monthly time frame, I do want to call out that we are breaking out of this down channel, right? We broke out of it, and it looks pretty solid so far, a pretty good breakout on the monthly time frame. So even if we start pulling back, it's still a pretty good sign overall for gold. Now let's continue on to a couple other charts. I want to look at the GDX. The GDX was up almost 14%. And I just want to call out that it is flagging right here. This is a chart that I showed a while ago or in some previous gold videos that I've done, but you can see the 50% retracement, it held. Now we're back above that 38.2. So if there is downside potential, maybe we get, you know, pull back to around 50% marker of this last monthly candle, and then we can maybe find some support. But this one also, if we start breaking out, could be a good one to watch. Just keep in mind, if we break out, I mean, from where we are right now, right at around 35, if we come and test this top, that's to 45, which is a very, very large percentage point gain there. So it's going to be one to watch. GDXJ, if you want even more leverage, these are the junior miners. It did get back above that 50% retracement level, also in that down channel flag, you can call it. You can see the stochastics is starting to turn up there too as well. Very similar to the GDX. If you didn't catch that, the stochastics here looks a little bit better as it's turning up like so. So it could suggest that we have some more momentum to the upside. You see that RSI above that 50 marker too. So overall, it is looking good. GDXJ looks a little bit laggard behind, but sometimes they move hand in hand. All right, let's take a look at the dollar right now. So the dollar has been kind of floating up very nicely here ever since this bullish crossover took place. We are above that 5 EMA, the monthly 5 EMA. The candle itself looks like a little bit of an indecision, right? We opened up, we came down, we came up, and we closed basically where we opened. And we're right there, right at around back testing this trend line, and that's in confluence with that upper Bollinger Band. So we could be potentially in an area where we're going sideways, or just pausing out potentially to see some more upwards momentum. The PPO down here, it's still below zero, but it is still pointing higher. So the higher the dollar goes and the rate at which it goes up higher, it's something to very carefully watch out for, because that could continue to put pressure on equities, which we've been seeing a very tight correlation between the two. As far as positive, negative developments, I guess however you look at it, right? It could be positive for some people, it could be negative for others, but the 10-year yield, I'm going to say this is a little bit more bearish taking place, and I'll explain why. Not necessarily just for the 10-year yield, but how yields are flattening out more. But the 10-year yield, even the 30-year yield, you know, it was down 7.4% today. So it dropped to, where do we close? Yeah, 1.8. So a very big move down in yields. And we've been tracking this rising wedge, right? We've been saying, hey, let's keep an eye on TLT. And we saw a big move today in TLT, and this is kind of coming off. Now, the reason why it could be potentially bad, well, first and foremost, when this drops, you can typically see weakness in financials, right? So banks, they borrow long-term and they lend out, they borrow short-term, they lend out long-term, and that's how they make, you know, margin. And when this drops, typically that hurts financials. And also what hurts financials is the curve flattening out. So financials have been kind of in this sideways range and we're getting a bounce. But if this continues to drop, financials could go too. And financials make up a big weight in the S&P 500. So it could be hard for the S&P 500 to continue rallying in that environment. Now, on the other flip side is when the 10-year yield backs off, it could be good for growth stocks. But unfortunately, in this current environment that we're in, we're coming into a period where the Fed is trying to tighten monetary policy in a slowing growth economy. So what that could spell, even though that this falls off, it could still very well put pressure on tech, and we need to be very mindful of that. If we take a look at all the yields, you can see across the board they've all dropped significantly, and you can see they're continually tighten up. So you can see here the 10 and 2 is getting flatter once again, right at 0.39 bips, and then we have 0.46 on the 30 and 5. So we don't, on these big drops here, where you see like a big drop right here, I think that's when the CPI data came out or when the Fed came out. So when something, big takes place, you can see more significant movement. And we have the Fed talking here soon in March. So we'll see what they do, and we'll see how the spreads and how the bond market reacts to that news. If we take a look at the TLT, still happens to be a positive trade, right? We broke above that. We saw a big day today, up 2.19% in the Treasury bond ETF. So if you were looking at this, or you're looking at TMF, which is leveraged, big day overall. And that is one thing that we kind of talked about in yesterday's video, to keep an eye on bonds as well as utilities and so forth. If you haven't watched that, actually, I suggest you watch that, because I did talk about commodities too, that if they start taking out their weekly low, and I showed you some very interesting charts, if they start taking out the weekly low and they start backing off and bonds start outperforming, there's some very interesting stuff that takes place. So if you haven't seen that, go watch that video. I just posted it yesterday. Now, here's where it gets interesting. Michael Gayad, the author of some award-winning white papers. This is one of his indicators, and it's called the lumber to gold ratio. And in short, what it means is it's a risk on to risk off environment, right? So it flips between risk on and risk off. And if you look at the zero line here, that's the 13-week rate of change between this relative strength. And I'm not going to get too much into the inner workings of this, but I'll explain what it means when it flips. So when it flips down below zero, it means that it turns into a risk-off environment. So what that means is, if you are, driving your car down the highway and it's on risk on, which we are right now, that means it's a nice sunny day, right? So you can put your foot on the gas, you can drive fast, no cars are in the way, everything's fine, okay? However, if it goes to risk off, it basically says, hey, take your foot off the gas. There's rain, there's some puddles on the ground, there's a lot of traffic, there's fog, and you're driving at full bore, which, in terms of the stock market, that means you're leveraged up, you're long all this stuff, or you have just a lot of exposure, and you're heading into, a storm, or potentially, coming into a heavy area of fog where there might be somebody right in front of you and you have to slam on those brakes. So we're not there yet as far as risk off, but this does look like it can trigger somewhat soon. Now, that doesn't mean that there's going to be a crash, but what that does mean, like I said, it has a stronger potential for something bad to potentially happen. And this here has actually triggered to the downside on all big crashes. So when this is down below zero, we've had big volatility spikes, and that is what we need to be very mindful of. If you haven't read his white paper, I suggest you go read it. It's called Lumber Worth Its Weight in Gold. It's very easy. You can just Google it. And if you don't follow Michael Gayad, I'd suggest that you follow him too there on Twitter. Another one of his indicators, this is part of his beta rotation strategy. This is looking at the relative strength between utilities and the SPY. And this is looking at a 4-week rate of change. And you can see here, this is very similar, right? So risk on, risk off. But risk off is when the line goes above the zero line. And when it goes below it, that is risk on. So right now we are technically in a risk off, but it needs to have the weekly close there. So just giving you the heads up, this one's a little bit more erratic, but what I will say is, if you have all these indicators align, that is even more of a warning. So, right, so if this is going to hold above zero this week, and then we have the lumber to gold ratio, if that actually crosses down below zero and closes down below there for the week or next week, you really want to be on high alert. Another one to pay attention to here is, this has been working quite well, so I'm just showing you again. You don't need to put too much weight on this, but this is looking at the tips over Treasury bonds. And I apply a 10-week rate of change, and when it gets to around 1.3, 1.4, 1.5, it's been giving us an indicator of volatility just kind of around the corner. And what you can see here, 1, 2, 3, 4, 5, 6, 7 times it indicated, boom, volatility. It gave us a heads up that volatility was soon around the corner. And we triggered it twice right here, once again, but volatility is already high. So that's pretty interesting to me to see this trigger for the first time, where volatility was, the first time that I started using this, really, since volatility was this high. So can volatility shoot higher? Absolutely. And this could be indicating that we might see it here in the near future. And that kind of lines up with those other indicators too as well. How high can the VIX potentially shoot? Well, I'm looking at 45 on the VIX. And the reason why is because there's one gap up there. And that would be a lot of fear to take place in the markets. Now, if we take a look at the risk ranges, so we're going to look at the SPY on the daily time frame. We did nail, once again, yesterday's quote-unquote prediction, right? I like to kind of create just an idea of what might take place tomorrow. And what we said on the previous video was a higher high and a higher low. And well, we got that higher and higher low. And where do we stand overall, right? So we were down slightly on the day for the first trading day of the week. Now, where are we going to stand for March on the first trading day of March? You know, it's a very hard thing to determine. I know that there's going to be a lot of volatility. As you can see, the risk range is above 450 to below 425 right here. And that's a large range of volatility. Being that we closed right here, I think it's more than possible to extend a little bit further up and potentially get another high and not take out this low yet. Just looking at this, it looks like it has the potential to go sideways and potentially reach that 200-day. So we'll see here if it can get it. I do like the volume that came in today, right? And the volume right here on this bottom. So it could be very well forming a bottom. I know that's on everyone's mind. Hey, are we forming a bottom to head higher? Well, you want to give it at least 4 to 7 days. And right, we had one follow through day. Now we're, another higher high, higher low. So that's day 2. We have a lot more time to develop. So we'll see here in the near future what actually takes place. Now, from a bullish perspective, if we look at the BPSPX chart, it is working off that overextended area, which we've been waiting for, right? Came all the way down. Now it's bouncing from that level. So that is a good sign, which means that we have still a lot of room to go up higher to bring the indice up further as well. Now, if we take a look at the financials, right? Financials hold a large weight. Financials is also pretty extended to the downside as well. And the last time I used this was on this positive divergence right here, and you can see that it moved up. So now I'm bringing it back only because I just wanted to point out that it is getting back to overextended, and overextended could stay overextended for a while. But just understand that when things are overextended like this, when we're getting a reading where only 40% are on buy signals, this could very well turn up, which could add extra movement into the SPY to the upside. Now, if we take a look at the Qs, also put in a higher high, higher low today. So it's a bullish development. As far as volume goes, slightly less than the previous day, but it's not horribly low. It's still relatively high looking back to these past trading days over here. What do I think could potentially happen? I mean, given the amount of volatility that's in this risk range right here and how news can shift things so quickly in this environment, I think that just looking at this, I think it's still possible to put in a higher high and higher low going into tomorrow, but I'm getting a little cautious as of right now, given the wild price action swings today and all of the news that has been dropping. But overall, just keep this in mind, right? We're still below that 200-day. We're still below a declining 50-day moving average. So there is a lot of work that needs to be done to recover what's been taking place. And when you really look at this chart, I mean, you have a high, a lower high, and a lower high, a low, and a lower low. So this is trending down, right? This would have to it would have to go significantly higher, do some back tests, and build a base before really comfortably feeling like we can actually start seeing another high here in tech space. And it's just not there yet, right? Especially with this type of volatility. Now, if you look at the BPNDX, it did get overextended, right? And we said when it gets overextended, we like to look for long positions, and it started bouncing from that area on a positive divergence still, and we're moving up, right? We're still below 50, but it's moving up in the right direction, saying that way we can potentially head higher. So that is a good sign for now. And then we look at the Russell, we're up slightly on the day as well. You can see here, we're still below that declining 50-day moving average, declining 200-day moving average. And just note that the upper risk range is at 210, which matches with the breakdown area of all that trap supply from over a year ago. So we'll see if it can recoup it. That's going to be a lot of work. But just know this type of move, that's a very strong rally, and it's going to get digested at some point, right? We put another higher high, another higher low. We're going to have to see this digest here eventually. It's not going to be a straight right up. It might feel like that on certain specific days, but as it stands in reality, we can see boom, 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 strong days, right? 1, 2, 3, but then you saw 2 pull back and then we headed higher. So we saw boom, 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 3 strong days. You're going to see a day where it turns red and it's going to shake some people out. So be mindful of that. All right, everybody, that's all I have for you on today's video. Hope you gave you some insight into some of the risks that I still see out there building, some of those indicators that Michael Guyad uses, some of the indicators myself. It does look like in the short term we could still potentially head higher, maybe retest the 200-day moving average this week or maybe the following week. But just note this. The curves, they are flattening. This is not a good sign for the markets overall. So, it's going to be a very difficult trading environment, especially for people that are long tech, if this continues to flatten out, as well as people that go long financials. So just be very mindful of what's taking place, especially how the market's shifting around with all these different news headlines. And we're heading on top of that into a Fed meeting, and we don't know what is to come. See you on the next episode, everybody.